Markets don't punish you for being wrong. They punish you for being forced to act at the wrong time. Financial stability is not making more money. It's building a structure where your obligations can't trigger forced selling, where volatility can't break your plan, and where your time horizon stays intact. The myth is that stability comes from a perfect budget or a perfect portfolio. The reality is simpler. Stability comes from a few minimalist rules that control liquidity, risk, and cash flow timing. I'm going to give you those rules like we're in a private investment lab. Constraints first, then execution. Think of your personal finances like a trading book. You have inflows, outflows, and exposure to uncertainty. In markets, the trader who survives isn't the one with the best ideas. It's the one who manages margin, sizing, and drawdowns. Your margin is your liquidity. Your position sizing is how much of your net worth is exposed to price moves and income risk. Your drawdown is what happens when life hits. Job loss, rate hikes, medical bills, a market sell-off at the same time. The mechanics are brutally consistent. If your liabilities are fixed and your assets are volatile, the wrong sequence of events can wipe you out even if, on paper, you're right long-term. That's sequence risk. That's why stability is a risk management problem first and an income problem second. The biomechanics of stability come down to incentives and friction. Your brain wants comfort now and certainty now. Markets deliver uncertainty and delayed reward. So the minimalist rules must do two things. They must remove decision-making from high-stress moments, and they must prevent catastrophic outcomes. Most investors misunderstand this because they focus on upside, how to earn more, invest better, find the next opportunity, while ignoring the plumbing that keeps them solvent. They optimize returns while their cash flow system is fragile. That's like optimizing a race engine while your tires are bald. Rule 1. You maintain a liquidity floor and you never violate it. This is not an emergency fund as a vague idea. This is a floor, like a risk limit, that protects you from forced selling. The market version is simple. If you trade without enough cash, volatility becomes a margin call. Your personal version is the same. If you invest every spare dollar and a shock hits, you sell whatever you can at whatever price to meet obligations. Stability requires you to decide in calm conditions what number makes you unbreakable. That number is a function of your fixed monthly burn and your income reliability. If your income is stable and your expenses are low, the floor can be smaller. If your income is variable or your life is leverage heavy, mortgage, dependents, variable rates, the floor must be larger. The point is not safety theater. The point is control over timing. You apply this with a clean sequence. You calculate your non-negotiable monthly burn: housing, food, utilities, insurance, minimum debt payments, transportation to earn income. You choose a floor in months of burn. Then you build it in instruments that behave like cash: high-yield savings, T-bills, money market. Then you create a rule. This floor is not investable capital. It is operational capital. When the market rallies, you do not redeploy it. When you feel behind, you do not redeploy it. It is there to prevent you from selling long-term assets during drawdowns. If the market drops 25% and your income is fine, you respond by doing nothing to the floor and continuing contributions. If the market drops 25% and your income is hit, you respond by living off the floor while you stabilize income. You do not liquidate your long-term positions at distressed prices. The failure point here is impatience. You'll look at a bull market and call cash wasted. In this lab, cash is not an asset class. It's a volatility buffer for your life. Rule 2. You cap your fixed obligations. Financial stability dies when your fixed monthly commitments eat your flexibility. In markets, fixed liabilities are like short volatility positions. You collect small benefits until you get hit hard. The biomechanics are cash flow timing and rates. If your housing payment, car payment, subscriptions, and debt payments are high, a small shock triggers a big problem. Minimalist stability means you keep fixed obligations low enough that you can absorb variance without breaking. Most people misunderstand because lenders approve you based on gross income and recent history, not on downside scenarios. Approval is not affordability. Here's how it looks in execution. When you consider a new fixed payment, you run a stress test. Assume income drops. Assume expenses rise. Assume rates increase if it's variable. Assume a market drawdown if you're also investing. If that payment forces you to dip below your liquidity floor or stop contributions, you don't take it. If you already have high fixed obligations, your response is to unwind them systematically. You refinance only if it reduces risk, not just payment. You cut recurring subscriptions. You downgrade liabilities before you chase more income, because reduced burn is an immediate, guaranteed improvement in stability. If rates rise and your payments increase, you respond by protecting the floor first, then cutting discretionary spend, then reducing risk exposure. Only after that do you look for additional return. The failure point is ego spending and lifestyle anchoring. Stability requires you to buy freedom, not appearances. Rule 3. You automate the base plan and reserve willpower for exceptions. Markets punish discretionary execution. The trader who feels it out gets chopped up. Your finances are the same. The mechanics are behavioral. Automatic flows beat intention. You don't want to decide every month whether you'll save, invest, or pay down debt. You want default behaviors that happen even when you're busy, stressed, or distracted. So you set up a base flow that triggers when income arrives. The first transfer tops up your liquidity floor if it's below target. The second transfer goes to your highest priority objective, either high-interest debt payoff or long-term investing. The third handles fixed bills. The remainder is discretionary. If you're paid irregularly, you treat each deposit like revenue in a business. You allocate percentages rather than fixed numbers, and you keep a slightly larger floor. When the market is euphoric and everyone is posting gains, your automation keeps you steady. It doesn't let you over-allocate into risk. When the market is crashing, your automation keeps you contributing without panic. Failure points are tinkering and just this month exceptions that become permanent. Rule 4. You separate money by time horizon and you never mix buckets. This is the minimalist rule that prevents dumb mistakes. The market mechanic is that short-term pricing is liquidity and positioning. Long-term pricing is fundamentals and cash flow. If you put short horizon money into long horizon assets, you create a forced exit. Most instability comes from mismatched horizons, using the stock market as a savings account or using illiquid investments for near-term needs. Your application is strict. Any money you need within 12 months stays in low volatility, high liquidity instruments, period. The reason is not that markets always crash, but that the distribution of outcomes is too wide on a one-year horizon. If the market drops right before you need the money, your plan breaks. Money for medium-term goals gets moderate risk and a planned glide path. As the goal date approaches, risk reduces. Long-term money gets the highest risk tolerance because time is your hedge. Then you define rules that stop contamination. If you want to buy something discretionary, it comes from the discretionary bucket, not from selling investments that are down or raiding the floor. If the market does X, sharp drop, your response is to rebalance within your long-term bucket if your rules say so, not to borrow from other buckets. The failure point is the illusion of flexibility. People think they can just sell later. Markets don't schedule themselves around your deadlines. Rule 5. You keep risk exposure proportional to your ability to hold through volatility. This is the position sizing rule for personal finance. The mechanic is that volatility is not just a number, it's a behavior trigger. If you're overexposed, you will sell at the wrong time. The wealthy mindset is not be brave. It's size so you don't need bravery. So you decide in advance how much drawdown you can tolerate without breaking rules. If a 30% portfolio drawdown would make you panic sell, then your allocation is too aggressive. You adjust it until you can hold. If you're early in your career with stable income and low obligations, you can take more volatility. If you're approaching a major goal or your income is shaky, you reduce risk. If the market enters a high volatility regime, wide daily moves, rising credit spreads, liquidity stress, you respond by tightening risk. Smaller new positions, higher cash allocation, higher quality exposures. You don't need to predict, you need to avoid getting sized out. The failure points are overconfidence in bull markets and paralysis in bear markets. Proper sizing fixes both. Rule 6. You pay down toxic debt before you invest like a genius. High-interest consumer debt is negative carry. In market language, it's paying a guaranteed high rate while hoping your investments beat it after taxes and volatility. That's not investing. That's gambling with leverage. The biomechanics are rates and cash flow fragility. Toxic debt raises your burn and lowers your flexibility. It also increases your risk of ruin because it demands payments regardless of market conditions. Execution is straightforward. If you have revolving debt at high APR, your first return comes from eliminating it. You structure payments like reducing an oversized losing position. Consistent, automatic, and non-negotiable. If your income increases, you accelerate payoff rather than expanding lifestyle. If the market rallies, you don't get distracted. You stick to the payoff schedule because stability is built on removing forced obligations. Once toxic debt is gone, you can take risk from a position of strength. Failure point. People want the dopamine of investing while ignoring the guaranteed drag. Rule 7. You run a minimalist signal set and ignore the noise. Stability improves when your decisions are triggered by signals, not by headlines. In markets, most news is priced fast. Your edge as a retail investor is not speed, it's discipline and a long horizon. The biomechanics are attention and impulse. The wrong information diet turns you into a momentum chaser and a panic seller. So you define the few signals that matter to your plan. For stability, your signals are your liquidity floor status, your fixed obligation ratio, your debt status, and your risk exposure relative to horizon. Market signals matter only insofar as they affect your execution. If rates are rising and your debt is variable, you prioritize reducing that exposure. If the market is selling off but your horizon is long and your floor is intact, you keep contributing and consider rebalancing if allocations drift. If valuations are extreme and you're tempted to chase, you respond by slowing deployment and keeping dry powder. The failure point is thinking you must always do something. In a good system, most of the time, you do nothing. Now, we've built a minimalist rule set that already makes you hard to break. Here's where most people stop, but here's the advanced layer. The advanced layer is designing for regime shifts and risk of ruin math because stability isn't tested in normal times. It's tested when correlations rise and liquidity disappears. In a stress event, assets that look diversified can move together. Your income and your portfolio can get hit at the same time. That's the correlation trap. You think you're safe because you own multiple things, but they share the same driver, liquidity. Advanced stability means you plan for the joint failure scenario. You assume that in a recession-like regime, job risk rises, markets fall, and credit tightens. Your response is pre-built. Your liquidity floor covers obligations, your fixed obligations are low enough to be manageable, your risk exposure is sized for drawdowns, and your contributions continue if income persists. You also understand that illiquidity is a hidden risk. If you load up on investments you can't sell, private deals, long lockups, speculative assets with thin liquidity, you may be wealthy on paper and unstable in reality. So you cap illiquid exposure to a level that doesn't threaten operations. That's the risk of ruin logic. You don't need maximum return, you need maximum survivability. The wealthy mindset is to avoid the one mistake you can't recover from. You also upgrade your decision rule during volatility clusters. When volatility rises, your normal assumptions about price behavior weaken. Stops can get hit by noise. Correlations spike. In that environment, stability comes from reducing new risk and increasing optionality. If the market starts whipsawing, you don't double down to make it back. You reduce size, widen your time horizon, and focus on process. The behavioral trap is revenge trading with your life savings, chasing returns because you feel threatened. Your minimalist rules prevent that because they anchor you to liquidity and horizon. Now integrate this into a training loop so it becomes automatic. You train stability like you train execution. You run a weekly review that takes 10 minutes. You check whether the liquidity floor is intact. You check whether fixed obligations increased. You check whether toxic debt is shrinking. You check whether risk exposure matches your horizon. You record a few numbers: months of liquidity, fixed cost ratio, debt to income, and portfolio drawdown. You don't need a complex spreadsheet, you need a consistent scoreboard. The goal is retention, keeping the rules alive in your behavior. You journal decisions only when you break pattern. If you made an unusual purchase, you write the reason and the impact on the floor and fixed obligations. If you changed allocation, you write the signal and the rule it followed. Over time, you'll see your failure modes. Maybe you overspend when you're stressed. Maybe you chase when markets rally. That's not a character flaw, it's a system gap. You then build friction against it: spending limits, delayed purchases, smaller position sizing, automatic contributions that leave you less room to make mistakes. You combine these minimalist rules with investing tools without letting complexity destabilize you. Valuation tells you when expected returns are high or low and helps you pace deployment. Macro tells you about the discount rate and liquidity regime, which affects volatility and correlation. Technicals help you manage entries and exits if you're tactical, but stability requires that any tactical activity sits on top of the base plan, not replacing it. Risk management is the glue. You decide how much you can lose, and you refuse to violate it. To test under pressure, you do pre-mortems and stress tests. You simulate a scenario. Income drops for 3 months, markets fall 30%, and rates stay high. You run your rules. Does your floor cover burn? Do you avoid selling long-term assets? Can you still pay obligations without panic? Then you simulate the opposite. Markets melt up and everyone around you is doubling money. Do your rules stop you from overexposure? Do you keep the floor intact? This is how you build stability that survives both fear and greed. If you want a single master rule to replay and internalize, it's this. Stability is created when your liquidity floor protects your time horizon, your low fixed obligations protect your liquidity floor, and your position sizing protects your behavior under volatility. Miss one link and the chain breaks. Catch the chain and everything else becomes easier because you're no longer negotiating with the market from a position of urgency. Rewatch this once and pay attention to the sequence logic. Floor first, obligation second, automation third, horizon separation fourth, sizing fifth. That order is the difference between feeling stable and actually being stable.